Hi, a quick video here from Money Talk on the three mechanisms that would be driving the stock prices in things like GME, etc. now. So as you know, there's high demand caused by the forums out there. And so what this means is the first one is buyer demand. This pushes the price up because there are more buyers than sellers, right? It seems logical. But there's only 50 million shares of GameStop in circulation. Compare that with something like Apple, where there are 15 billion shares in circulation. And you can see why a huge demand can push the price so much. The hedge funds that they targeted, now that was also another reason, right? Those hedge funds already established a position at some time in the past, which they knew of, and they established it at a certain price. So that leads me to the second one is short covering. Short covering, these hedge funds potentially sold the stock at $10 or $7, who knows. And therefore, when the stock price reaches, say, 100, they're losing, $90 a share, and they have to crystallize their loss. They'll be scrambling to buy those shares. So also, they didn't just create that sale out of nowhere. They had to borrow those shares in order to sell them. So not only is the risk, is the crystallization of their loss a reason for buying the shares back, but also they might be called back by the original owner. Also, these hedge funds lost out because they would be paying an interest in order to borrow that stock. So short covering is the second one. The third reason is that options are where a lot of the, say, Reddit forum buyers would have used options and bought one option, which gives exposure to 100 shares. So they buy one call option at, say, $10 strike, and whenever the stock goes above $10, it means that they will receive stock at $10 and be in profit at wherever the market price of the stock is. So they pay a premium for that option, and that's their max loss. Their max gain is unlimited technically, because the stock could be $1,000 next week times 1,000, buy 100 shares from that one option. That's a lot of money, right? The sellers, on the other hand, the sellers of the options, they try and mitigate their risk on day one. So they think, okay, in the future, I might have to deliver shares higher. I don't want to do that. I'll cover my position now, and they cover their delta accordingly. Now, today, if they at one point when they sold an option, they might have had to buy 35 shares per one option. So they don't quite cover all 100 shares. Now, as the stock rallies, that creates a squeeze on them, because there's an almost a certainty that they're going to have to deliver 100 shares per option because they are in the money. So they will even buy even more shares to cover their short call position. So those option sellers are another reason why the stock price or the demand for that stock goes up.